And whatever the revival took place after FY10 was because of the revival in the manufacturing sector.
Can you just hold on to that thought, Soumya? Finally, the PIB has decided to oblige us with the actual table, so I could be able to give you all the details. Agriculture, like I told you, fourth quarter is 6.3%. Mining and quarrying is minus 0.4%. A tad better than the Q3, which was minus 1.2. Electricity has come at plus 7.2. I think that's not a surprise. The IIP numbers gave indication for that. Construction is pathetic, as bad as third quarter at 0.7%. Trade, hotels, transport, and the big guy out there is still quite bad at 3.9%, a marginal improvement over the 2.9% that we saw in the previous quarter. Finance actually has come in at 12.4%. That 14.1% in third quarter was clearly because of all those FCNR deposits that came in. But 12.4 is not a bad figure at all. And the final number, primary community, social and personal services, largely government services, has come in at 3.3%, which I think must be a fairly bad number. We had a 2.8% year ago as well, but that is a fairly bad number. Well, that's the exhaustive list as far as the breakup is concerned. Now, if I can come to you, Sonal, first thoughts.
Broadly, Lata, no big surprises here. Like I said, I think non-agriculture GDP growth has slowed down this quarter because of a mix of factors, both on the investment side, export side, I think would be weak, as well as on the slower government spending side. So there's nothing much here in these numbers. I think broadly domestic demand remains very weak. Obviously, the GDP numbers are backward-looking data. And what we really need to focus on is, how soon growth is really going to pick up and what are the drivers of this growth recovery going forward.
Okay, Sajid, if you can hear all the numbers, your first thoughts?
Is the headline number 4.6, 4.7?
Yes, the headline number for the fourth quarter is 4.6. For the full year, it is 4.7. And okay, just to revise, since Jayesh and you have just joined us, I could read out the other ingredients as well. Agriculture has come in at 6.3 for the fourth quarter. Mining is minus 0.4. Manufacturing is minus 1.4. Electricity, gas and water supply is plus 7.2. That's the best strike rate in the 4 quarters. Electricity, that is. Construction, pathetic at 0.7%. Trade, hotels, transport, communication, the big services boy, 25% of the GDP comes from there. That is 3.9%, a tad better than 2.9 in the previous quarter, but really nothing to write home about. Services is bad. Financing alone still keeping its head above water at 12.4%. Good FII flows and credit offtake, but it is lower than that 14.1% which we struck in the third quarter because of the FCNR deposits. And finally, community, social and personal services, the government sector coming in at 3.3%, lower than the 5.7% of third quarter. Sajid.
No, Lata, really no surprises here. I think just a couple of observations. I think there's this discrepancy the last couple of quarters between Main Street and Wall Street. Main Street's been very weak, right? Except for power, except for electricity, weakness across the board in terms of industry, weakness in terms of trade services, which are most allied to industry. The only two drivers of growth in this quarter have been financial services, but that are kind of divorced from what's happening on Main Street, and agriculture. I think the only point I want to make is that, remember, this is a year with very strong agricultural growth. I suspect the full year number is somewhere between 4.5% to 5%. And despite that, you end up with a full year GDP of 4.7. Now, on this high base, if agriculture is going to grow at best 2% next year, and you want GDP growth to accelerate to above 5%, it just tells you how much work industry and private services will have to do, because there's no room for a fiscal stimulus. So I think it's, water under the bridge, but a reminder of generally how weak conditions are in the industrial economy.
Okay, I'm going to take that point forward with Sajid made, that it is a reminder of how weak the economy or the macros are. And Jayesh, just taking that point forward, do you think that the bonds might react negatively for this data combined with what we saw for the fiscal deficit data for FY14 that just came out some time back?
No, I think bond, of course, went through a very volatile day today, and with this number, they would be actually more looking forward for some positive news on the policy, which we will come to know only on 3rd. But I think Monday there will be expectation that the policy would not be that hawkish, and if that does not come, market would be disappointed. So that, I think whole of Monday people will be more focused on policy, and then of course we have budget next month. So at this juncture the trigger is going to be policy. Today of course market, you had statement from governor. The growth is also equally important to be focused simultaneously. That's a priority. So that's where how we go about it, we will come to know only on 3rd. But the Monday would be very, very exciting day. With you would see quite volatility in that on Monday.
All right, Jayesh, okay, let me come to some other data which we get and which usually is not relied upon, but nevertheless we have to go with it. Private final consumption expenditure actually has shown a little bit of a pickup. I think it rose by 2.5% in the 3rd quarter. Y'all correct me if I'm wrong. Yeah. It has risen by 8% in the 4th quarter. So that may be a bit of a positive, the rise in private final consumption. Government consumption year on year has fallen by minus 0.6, so perhaps close to a 1% fall. And what is a bad number is capital formation. Gross fixed capital formation falls by 1%. So that again is quite a terrible number. Exports, like they did in the 3rd quarter, have risen by about 11%. So I would want your comments on that. If you are interested, I could give you the bigger number as well. Final consumption, private expenditure comes at 9.78 lakh crore compared to just 9.04 lakh crore. That's the rise of about 8%. Gross fixed capital formation has fallen to 5.35 lakh crore from 5.4 lakh crore in the previous 4th quarter. And government expenditure again marginally lower at 1.77 lakh crore from 1.78 lakh crore. Saumya, you wanted to comment on this capital formation? A fall of 1%. There was a contraction, a similar contraction, I think, last quarter as well. No, last quarter either the numbers are revised. It's a marginal higher number. But this quarter clearly capital formation has contracted from year ago levels. Does that further dishearten you?
See, I think it was not entirely unexpected decline in capital formation, because the way there has been a trend in capital formation, we are not expecting a revival in that segment, at least in this quarter. But only one silver lining which I would like to point out, I don't know whether you have the data, but one thing is that if you look at the last couple of quarters, there has been a significant inventory drawdown by the corporates. I think last quarter it was around 1.6% of GDP. So what is important right now, if there is a manufacturing sector revival, which has been the case after FY10, and if that inventory revives, I think that will facilitate a faster growth turnaround than what was expected. And the other thing which is a little bit unrelated is the information on the finance, insurance related business sector, which I think it has grown again at a rate more than 12% in the 4th quarter. So I think that the traction from that segment is not only from the finance side, which is typically has been bolstered by the deposit and credit growth rate, and which are outliers, but also some good growth rates in the sectors like legal, accounting, computer related services, which continue to do well for the last couple of years in spite of an overall slowdown.
All right. Well, actually